In this video, we'll look at a couple of additional problems, which will include one problem that has a twist that we haven't looked at yet, and we'll look at another problem that has multiple products. If you read through this problem, you'll see that there's really only one product. However, there's three different levels of fixed cost, depending on how many lanes they keep open. So in a typical cost volume profit problem, a simple one, we have a quantity versus cost, right? The fixed cost is the green line, and the contribution margin is the blue line, and where the total contribution margin intersects the fixed cost, that of course would be the break-even point. However, in this problem, the fixed costs are what we call step costs, in the sense that for Q between here and here, right, the fixed cost is constant. But once we get to a certain level, we run out of capacity and have to open up a new lane. Opening up a new lane means the fixed costs now jump up to this level. And once again, that gives us a certain capacity, and then at some point we run out of capacity and the fixed costs jump again. So that means that we have 3 points of intersection, or 3 potential break-even points. So the first question is to calculate the break-even points, and that's not too difficult to do. We just calculate the contribution margin per unit using the information here, and then we have 3 different levels of fixed cost, so we would want to do that. So here's the break-even point for one lane. So the fixed cost is $33,000. The contribution margin per unit is 10 minus 4, or 6. And you can do the arithmetic to figure out what the break-even is. Now, when there are 2 lanes, the fixed cost is $39,000. Once again, the contribution margin per unit is 10 minus 4. And if you finish the calculation, you'll get the break-even point for 2 lanes. For 3 lanes, I'm going to let you work that out. You have the pattern set for 1 lane and 2 lane. It shouldn't be too hard to complete. Now in part B, they say use the maximum quantity for each of the number of lanes. So 5,000 for lane 1, 8,000 for lane 2, and 3,000 for lane 3, and then calculate the profit. Well, I'm going to use the formula that profit equals contribution margin times the number of units minus the fixed costs. When I do that for 1 lane, I get a loss of 3,000. For 2 lanes, it's $6 times 8,000 minus 39,000. And once again, I'll let you complete the calculation. And for 3 lanes, well, as before, the pattern is set, and you should be able to complete the calculation and determine whether the maximum profit is 1 lane, 2 lanes, or 3 lanes. In this problem, we have 2 products, AU and NZ, and we have various parameters: selling price, variable cost, number of units, fixed cost, 2,208,000. And then we're asked, what is the anticipated level of profits? What is the break-even point? And what happens when the sales mix changes so that they sell 4 pairs of AU to 1 pair of NZ? To get started, you would want to calculate the contribution margins for AU, for NZ, the mix for AU, the mix for NZ, and then the fixed cost. So I'm going to leave this blank for the moment, let you work it out. The solution is on the next slide. All right, so I filled in the contribution margin as $100 for AU, $80 for NZ. The mix is 60% for AU. Well, remember, there's 60,000 AU, 40,000 NZ, so that totals 100,000. So 60,000 divided by 100,000 is 60%. 40,000 divided by 100,000 is 40%. So the weighted average contribution margin is 100 times 60% plus 80 times 40%, which is equal to 60 plus 32, or $92 per unit. Now we're in position to answer question A. So we take the weighted average contribution margin, $92, times the total number of expected units, 100,000, minus the fixed cost, and that will give us the expected profit at that level of operations. I'll let you complete the math. Here's a related problem. What's the break-even point? Once again, remember, the Q is the total number of units to break even. So we take the fixed cost. Remember, these would have to be common or shared fixed costs, 2,208,000, divided by the weighted average contribution margin, $92, and you'll come up with some value. Don't know what it is offhand. You can work it out, and it'll be so many thousands of units. And remember that under the assumption, whatever this answer is here, 60% of them are AU and 40% of them are NZ. Regarding part C, remember that currently 6 out of 10 are AU and 4 out of 10 are NZ. Now what happens if the mix goes so that 4 out of 5 are AU and 1 out of 5 is NZ? Right, so if you work that out, then the new mix is 80% AU and 20% NZ. So that means we would get a new weighted average contribution margin, which would be based on $100 times 80% plus $80 times 20%. And once again, I'll let you work out what that math is. And so that's going to be the new weighted average contribution margin. And so now you could go back to the formula up here and figure out what the new total number of units are that have to be sold in order to break even. And that completes the 5th of 5 videos, and that covers all of the slides that I was going to show for Accounting 311 this week. If you have any questions, please send me some email.